Hello and welcome to a slightly unusual Any Answers Answered for April 2020. I trust all of you are well watching this. Very best wishes go out to everybody at this time. We are going ahead with me in my house and Tim in his. And Tim, as ever, we have two questions to look at. The first one is from Paul Soper, who asked a question about the new rules on payment and filing for residential capital gains. And his question, quite simply, is at what point do you have to report these capital gains? We knew that if they were small, they didn't need to be included. But the question he is asking, the first part of the question he is asking, is what if there were two separate gains in the year? The first small, say £5,000, therefore within the annual exempt amount, therefore probably not something you would report. But then a second, much larger gain later in the year. Does that mean that in fact the gains generally are chargeable and therefore the first one should have been reported? Tim, let's start with that question. Do I need to report everything if across the year it might take us past that annual exempt amount?
No, the legislation is quite clear on this. Suppose that, as Paul suggests in his original posting, the taxpayer sells a property in June of this year. June 2020 is completion date, and exchange was on or after 6 April 20. We should note, by the way, that the government have frozen the housing market, as it were, so there may well be rather fewer such disposals in the first or second quarter of this tax year than otherwise. But anyway, assuming that there is exchange and completion with completion in June, then within 30 days of that completion, so within July 2020, the requirement is to file the new online return and pay an estimate of the capital gains tax, but only are you required to do that if there is an amount of tax to pay, is the simple way of putting it. And in estimating that tax, you will be able to take account of any annual exempt amount that has not already been taken account of in an earlier residential capital gain for that tax year. And so we would, in respect of that completion in June 2020, have to make no return and pay no tax if the gain, as Paul suggests, was just £5,000. However, if later in the same tax year there's a further chargeable gain arising on a residential property disposal, then we would be able to use the balance of the annual exempt amount. I think that's now gone up to 12,300. So after the 5,000 already used, that would leave 7,300. And if the further gain exceeds that, we will be required to file the return and pay the estimate of the capital gains tax. And that is very clearly set out in the legislation. Paul's concern is that the revenue guidance does not make it quite so clear, and I'm afraid revenue guidance is quite often abbreviated, praising the legislation, so these potential misunderstandings can arise. What the guidance says is that the gains, including any other chargeable residential property gains in the same tax year, is within their tax-free allowance. And I suppose if I'd been writing that, I would have included the two words "to date" by saying the gains, including any other chargeable residential property gains in the same tax year to date, are within the tax-free allowance. So it is I can see Paul's point. There is another point about capital losses, and if before completion of the residential property gain, the taxpayer has made disposals realising losses, then they can be taken into account in deciding whether you've got to file a return and estimate the tax. If the losses cover the gain, you won't have to file or pay any estimates. But losses that you incur on disposals after the completion of the relevant property disposal cannot be retrospectively taken into account to generate a refund of the estimated tax. You would then have to wait until the end of the relevant tax year and file your tax return, and then do the calculation of the correct amount of tax, and that would then get sorted out in the annual self-assessment.
And then there's also this problem relating, it's not a problem, we just need to make sure we understand it, relating to exchange and completion. The 30-day rules all relate to completion, the tax year of assessment will be based on the date of exchange. And one of the points Paul makes in his example is that we could have situations where if we've exchanged but completion is delayed by quite a long time, we might end up reporting, if you like, in the traditional way before we have to report within 30 days.
Yes, I think the example he gives is exchange of contract March 21. So that falls in the 2021 tax year. And the self-assessment return and capital tax on that disposal would both be due on 31st of January 22. Now, when is completion? Well, if completion of that contract exchanged in March 21 was September 22, and although that may to many of us seem odd, it's not unheard of for there to be very lengthy delays between exchange and completion. But September 22, of course, completion then would trigger the online filing and estimated CGT payment at a date in October 22. But of course, by then, you've long since filed and paid the tax. I don't see that as a problem. If you have already filed and paid the tax under self-assessment, you won't be required to file again the online service for CGT and pay an estimate of what you've already paid. So I think that's an unnecessary worry there. And it may be if, say, exchange was in March 21 and completion was going to be in, let's say, July 21, well, there may be an advantage to some in filing your self-assessment return early in order to avoid the payment of the estimate, or at least you can calculate it. You would still have to pay the tax on the 30-day payday.
So caution required, but all of the answers seem relatively straightforward as long as we can work out exactly how it all fits together. Following those rules rather than the guidance, perhaps, is the way forward. Our second question this month comes from, and I never know how to say this, Alisonis, Alison is, Ali Sonis, I don't know. And it's a question on top slicing relief, Tim's pet subject, and one actually he's written a couple of articles for accountingWEB on. And Tim, the question here relates to the budget changes. And quite simply, what is the position for gains made prior to the budget changes? Can we get recompense for the change of decision?
Yes, Alison asks a question that has no doubt occurred to many agents whose clients have crystallised liabilities on chargeable event gains and been concerned at the Revenue's methodology for calculating top slicing relief. And included in the posts, I noticed that there's one from me telling everyone that the Revenue withdrew their appeal against the decision in the first tier tribunal case of Silver. They withdrew that appeal on the 17th of March. And that, I think, recognises that they were wrong and we were right all along. Now, the question as to how that is going to assist, and this is what Alison is asking, how's that going to assist those who had chargeable event gains before budget day, is a question not yet answered. The changes on budget day were twofold. The second of them related to the allocation order of allowances, and I have to say that is a far lesser issue and one that wasn't addressed in Silver and is not going to affect that many to a significant extent. But the main issue, the main change on budget day was to clarify that for chargeable event gains on or after budget day, the top slicing calculation, when it works out tax on the slice of the gain, can indeed use the relevant full, if appropriate, personal allowance by reference to the amount of the slice, not the full gain. Now, that is what the tribunal agreed should have been the situation in Silver. So effectively, the change in the legislation from 11th of March is not a change at all. There is one minor element, which is slightly different, but it is very minor. So my own position at the moment is that the Revenue should now accept claims for repayment of overpaid tax on the basis of the correct top slicing relief calculation as decided in Silver. They might argue that Silver isn't a binding precedent and that could be one of the reasons why they withdrew their appeal from the upper tribunal. And it may be that we need another tribunal case to confirm that overpayment relief claims are indeed to be met by HMRC, and that they can't hide behind the so-called practice generally prevailing rule. If the tax year in question is out of time for an overpayment relief claim, and Alison doesn't say in which tax years she's thinking of the gains having been made, well, if you're out of the 4-year time limit or deadline for overpayment relief, you might want to have a look at extra statutory concession V41, and that concession provides that if you're out with the 4 years and the overpayment was because of revenue error, which I would say this is, and the facts are not in doubt or dispute, repayment should be made.
Okay, and there was some good news in the wording, or potential good news in the wording of the new draft legislation as well, and their guidance in terms of they seemed to be confirming things. They were saying that it was to put things right, if you see what I mean.
That's right. They used phrases like clarify, put beyond doubt, and following Parliament's original intention, all of which I think the original legislation did anyway. But that further supports the suggestion that our interpretation was correct, the Revenue's interpretation was wrong. Excellent.
Well, hopefully those two answers to those questions are useful. We will be back next month to look at 2 more questions from the Any Answers pages of AccountingWEB. But for this program, bye-bye.